Good, happy Monday to everybody. This is Connie Hill. Happy you're joining us here for our Straddles and Strangles webcast. Happy to see so many of you here. Several of you are familiar names, which is nice. And I know we have some new people joining us here today as well. Now, our focus today is really to discuss the difference between straddles and strangles, because they're basically the two strategies that we work with in this class. But there are some varieties. There can be short straddles, short strangles, long straddles, long strangles. Today, we're going to be focusing on the long side of things as opposed to the short side of things. But when we're finished, hopefully you'll just have a better feel. How do you use these strategies? That's going to be our attempt here today. Now, I hope you're following me on X. I'm Connie Hill CS. I hope you're following Cameron May on X. He's Cameron May CX. He's here to help us in the chat. He's going to keep his eye as far as some of your questions go as they come in. I'll be keeping my eye on the chat as well. Cameron might have to pick up some things that I can't quite get to, but we do want to hear from you, so let us know what your questions might be. Now, let's go ahead through our disclosures, and then we're going to jump into our agenda. Quite a bit to cover here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes only. Don't consider it a recommendation. We're going to be using the Paper Money software application. This is the most robust version of Thinkorswim. You download it to your computer, and it mimics your live trading account pretty well, but there are some differences. One difference is that in Paper Money, short options are not assigned early, but in a live account, that certainly could happen. So when we have those opportunities, I try to point those out to you. Investing involves risk, including the loss of principal. When we talk about probabilities, keep in mind they're theoretical in nature and not guaranteed. Past performance is no guarantee of future results. Now, one thing I failed to mention is if you are listening to this on the recording and you have questions, Cameron and I aren't going to be there to answer them for you immediately. But go ahead, chat your questions into the comments section on YouTube, because I go back and review those throughout the week. Make sure you get your questions answered quickly as well. Now, we're going to take a quick look at the market, see what's going on here today. I think we're grinding a little bit higher and a little bit higher. We'll take a look at the charts here real quickly. We'll talk just briefly about advanced option strategies, because straddles and strangles are considered a little bit more advanced. We'll talk about why that's the case. And we are going to be looking at a lot of examples here today. Now, as far as an announcement here are some upcoming events that if you are in the vicinity or can easily get to one of these, it would be great for you. So this coming weekend, the Market Drive event, that's going to be on Saturday at the Renaissance Schwab Conference Center. It's a really nice facility. I was there a couple of years ago. Then we've got San Diego, June 5th and 6th, and then again, another workshop, option strategies and technical analysis. That'll be on the 17th and 18th back in Chicago. So Chicago's getting kind of spoiled here for a couple of months in a row. But again, if you can get there, you will love these events. They're free, of course, to you. Now, let's talk a little bit about advanced options, kind of generally speaking. Now, they are a little bit more complex. And why is that? Well, it's because usually we're working with multiple legs, as opposed to, say, just a single leg. In the straddles and strangles area, we are always going to be using at least 2 legs, and sometimes we'll use 4 legs depending on the variation of the straddle or strangle. Usually in our case, they both have the same expiration date. There are some advanced strategies like diagonals where you have different dates, but in this case, they're going to be the very same. Now, one thing that's kind of applicable here in our class today is advanced options are not always, and many times they're not directional, meaning we're not taking necessarily a bias, okay? In the event of straddles and strangles, we don't know what direction the market's going to move or that the stock's going to move. Now, those of you that maybe aren't quite as familiar with straddles and strangles, we're going to get into that, but essentially this. A straddle is where we're using an at-the-money call and an at-the-money put. So they're going to be the very same strike price. A strangle, and again, these are long strangles as opposed to short, we go out of the money. Okay, so we might go out of the money on the put, out of the money on the call, but we're still buying one of each. And we do this because we're expecting a big move. We just don't know what direction the market's going to go, right? We all get to find out at once when the news gets released, say like earnings announcements is very common. We all get to find out there together. Now, one thing to keep in mind when we have these multiple legs, we will have transaction costs on both of those legs. So we always want to keep that in mind. That's a consideration when we're talking about any kind of strategy, right? You want to consider what your fees and commissions might be. Now let's head over to our Thinkorswim here. And where we're going to start, I want to just take a quick look at the markets. Now, I kind of mentioned to you, we seem to be grinding a little bit higher and a little bit higher. And that's what we're doing here today. We've had just this amazing run beginning on March 31st here. Let's get for that. On the 31st of March, this green candle here, man, we have had an explosive move up to the neighborhood. I'm going to say this is calculating for us up about 16% off that low. So we're not even halfway through the month of May, and we're up about 16% from that pop. So that has been a really interesting run. Now people are like, well, it can't keep going. Well, we'll see. Maybe it can keep going a little bit before it decides to take a breather, which is common, right? A little retracement or a little breather in the market action. Now, I believe the NASDAQ is acting equally bullish. Let's see, this is up 0.24%. NASDAQ, let's take a quick look here. It's up 0.15%, so not as much, but again, another new high. Look at that, another all-time here. The SPX did that as well. Well, we have an idea. Okay, we've got some generally still bullish market conditions that may or may not influence how we adapt to these trades, because they are not very much influenced by overall market direction as they are overall stock news. Now, let's take a look at our first example we're going to use here today, which is HIMS, Hims and Hers Health. These guys do a nice little business with a health and wellness application and business, and they've kind of had some interesting history here. Let's go back a full year. Let's just make sure we're there, and let's just kind of see where these guys have been. Looks like maybe earlier, say a year ago, about $65, and they had a hard time getting above that resistance area, and then a pretty decent pullback here. Looks like they've pulled back all the way to $13 and change, which is a pretty steep drop during that period of time. But what are they doing more recently? Well, more recently, they've been putting in some higher highs, higher lows, really improving their trend, kind of fighting back into things here. Now, the big news event coming up on HIMS is the fact they're going to have an earnings announcement. That announcement will take place tonight after the market closes. So if we want to have anything to do with this potential move, we've got to do it before the market closes today, but we're going to do it here in our class. Now, I want to point out a couple of things to you. Number one is what's called the market maker move. And you can see here I have a little script that's been pasted into my chart here, showing what the market maker move is. And so for those of you that maybe aren't as familiar with this terminology or this concept, it tells us how much the market makers have priced into the implied volatility of the options. Have they put in a big amount or a small amount? Now, this is actually one of the bigger ones we've seen in a long time. It's saying what they've priced in there, the stock is likely to move, or they're expecting it to move, not that it actually will, it's just theoretical, $4.65 up or down. And on a $29 stock, that's quite the move. That's about 15%. Now, over here on the right side, you can see we got these dotted yellow lines. And they essentially are mapping out for us that $4.65 move up or down. Now, I mentioned this is a pretty big number. Let's give you some context. Something that maybe wouldn't be considered all that big might be 2 or 3%. Something that's maybe a little bit moderate, not extreme, but maybe something between, say, 5%, maybe say like 8%, might be something where there's, okay, medium anticipation. Now, one thing with this strategy is we want to know if the stock has been making some big moves. We're seeing it's expecting a big move, not necessarily we want to go check the history on that. Now, I'm going to share with you a couple of things here. The first thing I'm going to share with you is this market maker move script, right? Those of you that are here live, I'm going to go ahead and paste it over into the chat so that you can take a look at that. Those of you that are maybe not sure what you do with such a script, let's do a couple things. Number one, I'm going to put it in a text box here. So those of you looking at this on the recording can maybe just pause the recording, get this script right here. And really, we're just going to go from this exclamation point forward. It's cap sensitive, so it has to be exact. So you might type that in or copy that in. Just come to setup, open shared items, do a paste. We're going to paste that formula in there, say preview. And then I've called it this. I've called it MMM chart marks. That's what I call this, so I know where to go find it again. If you don't like that name, change it. Make it something that you relate to. Okay, go ahead and do that. And then go ahead and hit import, and you can have that script on your charts as well. Once you bring it in, you have to add it as a study. Okay, that's where it's going to show up as a study script. Okay, so that's going to be something really useful and helpful for you to see. So let's go take a look at history here. Let's go see in the last year how much HIMS has moved on their earnings announcements. Now, the thing we're looking for here is gaps and tall candles. Okay, so the script I chatted into the chat. And remember, anytime we share a script with you, it's never guaranteed as to accuracy or timing. Okay, but if you want to use it, feel free to use it. Okay, now let's look at their history. So we can see the earnings back here. The last May earnings is a little bit off our chart. We're not seeing that in the 1 year, but let's just kind of zoom in here. These guys announced their earnings at night. I take that back. It announced it the morning before the market opened. So one night they closed here. The next morning they announced the news. And what was the reaction to it? Well, look at this. I'm going to measure it out here. We're going to go from where it closed down to where it opened, which is right about there. And it dropped down about 12.75%. It's a pretty decent move. Now you can see it was really volatile that day, right? Because it ran up. So it kind of actually went positive, even though it started out gapping down over 12%, ran up at one point in the day, and then it fell back down. That momentum just didn't hold. And then we see, yeah, the next day, man, by the time the next day was over, these guys were down about 19%. So that's a pretty big amount on in this case, it was a 29 or about a $65 stock at that point, okay? And then it continued to go down. Now, in this case, had we bought a call and a put, we could probably see here pretty quickly that the call was not going to do us much good. And it was the put that was really going to be the one to make the profit in the trade. All right, let's go to the next earnings announcement. Fast forward here. Again, they announced before the market opened, so they closed here. They opened up a little bit the next day, about 2.5%, 3%-ish, okay? But then it fell, okay, over the course of the day. Down towards the end of the day, it was only down about 2.5%, so not nearly as big of a move as that previous one, although look what it continued to do. Again, the put in this case would have been the winning one to have. And lastly, let's look at the most recent one. In this case, it didn't move that much either. So it's interesting to note that it has had some big moves. The most recent 2 earnings periods haven't been a lot, but yet the expectation is enormous here. Okay. And so sometimes history will show big moves, sometimes they're not there, and that's why we're paying attention to that market maker move. Now, where did this market maker move come from? Let's go to our hymns. And over here, I'm just going to kind of maybe circle it here. This is where we see that market maker move being up $4.72-ish, up or down. Now, the thing to know about this market maker move is just for the event. And the event here is earnings. Doesn't always have to be earnings. It could be an FDA announcement that they say, hey, on this date, we're going to tell you what we think, is it a go or a no-go? It could be maybe a lawsuit that's going to be settled. And so they're expecting a big move depending on which way the lawsuit goes. So like I said, it doesn't always have to be for earnings, although the stock we're looking at here today is specifically for earnings. All right. Let's do this. Let's kind of delete that there. Next thing I want to draw your attention to is the far left or far right hand side here. And the options where this is due to, have the news come out, or these weekly options right here that they expire on Friday. This is showing this 201.54%. What does that mean? That means that's the implied volatility priced into this series, the ones that expire on Friday. The ones that expire the next Friday, not nearly as much, but these are still really big numbers, you guys, 140% priced into these. And that is a huge difference, 201 and 40%. That's like what, 60% higher up here, which means these options are really, really expensive. And so we want to make sure we are expecting a big move if options are going to be that expensive. Now you can see as we go out further in time that drops, that implied volatility drops a little bit there. But it's still, I'm going to say, the 90s and high 90s are still pretty volatile options where there's a lot of expectation of movement that's being priced into these. All right, let's do this. What would we choose for our expiration? Which one would we want to go with? There's not a clear-cut answer here. Sometimes it depends on, do you think you might have to play the move for a little bit of time? What if this stock announced on Thursday night and the time you had to react to it was Friday morning? You might feel a little crunched for time by choosing the one that expires that Friday. So you might choose to go out a little bit in time. In our particular case, we're going to go out just one extra week. We're going to go out to the May 22nd because more likely than not, the play is going to be over fairly quickly, maybe a day or two, but if we need it for a little bit longer, we'll have it for a little bit longer. We could go out further if we wanted to. We could go out to, say, the June monthly expirations, or even further. We could pick whatever we want. So we're trying to balance having a lot of open interest because we want to make sure those contracts are being traded and we're not the only ones out there trading the contract. We're looking at bid-ask spreads. We want them to be narrow. And sometimes if you don't see that in some strike prices, but you do others, that sometimes helps make your decision whether you're going to do a straddle where they're at the money or a strangle where they're out of the money. So in this case here, the current price of the stock's $29.70. So our at the money strike price is going to be 30. And so if we were going to, which we are, do a long option, so we're going to go with the 30 strike price. So we're going to be using these numbers here. There's 197 open interest contracts, which is nice. And if we were to take the midpoint price, that's in this column here called Theo price. Midpoint price is about 309. So we would be buying a 30 call, or put on this side, then we're going to buy a 30 call over here on this side. That represents the straddle. So let's go ahead and do it. Let's go ahead and get that queued up. So I'm just going to click on the ask price for the put, and you can go in any order you want. I have this habit of starting with the put, so I'll go to the put side, then we'll go to the call side. This move is going to, these two contracts together are going to cost $5.88. So I kind of look at that and I see, well, it is more than what is being priced in here for the market maker move, but it matches up pretty close to this number to the side of the 140%, because this says plus or minus 595, which is going all the way to the options expiration. So this 474, just for the event itself, the continuation throughout the week, a move pretty close to about $6. And so, yeah, we can see that at the money pretty much is going to tell us what that straddle and implied volatility and the expected movement is. But if we go out a little further in time, say to the May 22nd, that gives us a little bit more time than the options expiring on the 15th. All right. So we're going to put this trade in just like it is. Now, some people might say, well, should we put stop losses in? And you can if you want, okay? You could say, gee, if either one of these gets 50% of what they're worth, get out. You could do something like that. You could set an OCO order or something of that nature. Or you could do what we have a tendency to do in our class, which is we don't put in an exit order. We see what the news is. We see, gee, does it look like it's going to go up or down? And pretty much one thing we need to consider here with the straddle is, well, what would our break-even point be? Now, we know, say, for example, on a 30 call, that if we were just buying the call itself, that our break-even point would be $30 plus whatever our premium is, right? So in this case, $32.83. On the put side of things, it's the same thing. It's whatever the strike price is, and then we're taking into account what the option premium is, because we need to have that big of a move in order to break even. Now, on two strike prices, we really need the thing to move, because what we're going to do is we're going to say one is a loser. One is whatever side the move doesn't go to, that's probably the losing side. And so in our minds, we're thinking, yeah, it's got to make a big enough move to make up for this premium of 590, okay, in order to get something beyond break even. All right, we're going to go ahead. We're going to put this one in, and then we're going to compare a strangle. Now, we're just going to do one contract here. And we're going to go ahead, we're going to hit confirm and send, and we're going to put it in our grouping called Straddles and Strangles, where we keep track of the trades that we're doing in this class. Now what we're going to do, and normally you wouldn't do this, okay? You would choose a straddle or you would choose a strangle. But we're going to do a little comparison here. And we're going to see which one actually does better, the straddle or the strangle. So let's go construct our strangle here. Now, the definition for a strangle simply is out of the money put and buying an out of the money call. It doesn't mean you have to go out 2 strike prices, 4 strike prices. You kind of get to choose that. And so you're trying to balance what is a little bit lower, but keep in mind, the further out we go, we have to keep in mind our break-even point, because our break-even point is going to be a little further out because we're going out of the money, plus whatever that premium is. Now, for our purposes here today, I'm thinking we're just going to go we'll go 2 strikes out of the money, but we're going to do $1. We're going to come out here to the 29. And so we're going to buy the 29 put. I'll go ahead and click on that. And then we're going to buy the 30 call. Okay, so 29 put and then 30 call, which would be basically 1 strike. It's actually 2 strikes, but $1 beyond our at the money straddle. Now, if this were a more expensive stock, we might have a lot that we might consider, okay? But because this is kind of a smaller dollar stock, we don't have a ton of choices. Now, notice this, the premium here is $5.31. The Strangle was what? It was about $5.90-ish, right? So it is a little bit less expensive, which is one reason why sometimes people might consider doing that, is to maybe get into a trade where you're like, yeah, it's likely to move pretty big, but maybe not cost you as much to participate in the trade. Now, one thing, someone's mentioning that in here right now in our chat. Assad says, I just don't understand why we're buying a straddle. This seems to be very risky. We probably will lose the majority of the investment after the IV crush. Several of you are noting the IV crush. Once the announcement comes out, you're absolutely right. Implied volatility comes crushing out of the position. Okay. And that's why the reason why we really need a big move is to do that. Now, straddles and strangles are speculative in nature, meaning they're probably not your bread and butter strategies that you're going to go to day in and day out. But you do want to feel comfortable with them so that when you see an opportunity where you might want to use it, you feel comfortable. Oh, I know about this strategy. I practice this in paper money. You could practice this trade with me in your paper money account if you wanted to get some exposure to these strategies. Okay. The reason we're doing this strategy is because it's the focus of our class, straddles and strangles. Now, you in this situation, you might go, I might want to be a seller of some premium, maybe do a selling strategy, which you could sell a straddle or a strangle. Again, today's focus is really on the long side of these versus the short side. But it has its risk too, right? If you're going to sell that premium. All right, we're going to put in our strangle here now. And again, we're just going to do one contract. We're going to watch the event as it comes out. And we're going to talk about that. Let's go straddles and strangles. We'll send this to the same place. Now, these guys announce tonight. So we're going to maybe get a little bit of a heads up on what's going on with this stock tonight. Now, I have something else that I'm willing to share with you. It's just a little grid, but I think it's really helpful for these strategies. Let me share it with you out in the chat, those of you that are here live. Let me go ahead, put that in there. And no, scripts are never guaranteed as to accuracy or timing. Okay. Those of you that are on the recording, I'm going to pull up the chart I'm going to share with you, and then I'll see if I can paste the link in there. Let's go ahead here. Let me pull this up. And this is the graph that I'm sharing with you. And it's a grid. And on the top grid, we have a ticker symbol, which is Monday. And in this chart, this says 5 days, 5 minutes, and that's because I manually changed it. Really, it's a 1 day, 1 minute chart. And then on this side of the grid, again, it's Monday, but this is a kind of a 3-month chart. And so what happens is, say on Monday, they announced this morning, we're not working with it as far as a play. We're not doing that. But what this will allow you to do is see what happens in the pre-market. Because Monday announced this morning, we could see what the immediate reaction was to it before the market opened. So tomorrow morning, I'm going to be having in here HIMS, HIMS, and I'm going to be able to see what's going on pre-market, post-market. And then we'll be able to see, well, how does that fit compared to, maybe what's been going on with the stock recently? Now, interestingly enough here, notice this went up to 93.35, but look how quickly it's fallen back down. In fact, it is pretty close to where it was when they announced. So it's almost taken most of that gain back that it had in the pre-market. And again, that's another reason why these are speculative trades. They have a tendency to be quite volatile. Sometimes you need to make a pretty quick judgment on it. And so we'll also watch, I should mention this for those of you that aren't aware of this, this grayish area here is our pre-market and post-market trading. And then where it's all black again, that's when the market opened. And I am in the Mountain Time Zone, so I have mine set to 7:30 is when the market opens here. And so this is the first 1 minute candle that it traded after the market opened. Okay, so we can see that big red up. And then here we can see over the last several minutes where is the momentum is just drained out of it. Okay, so that is why these charts are helpful. So like I said, tomorrow, or actually tonight, I'll be putting HIMs in here, and we'll be able to see the post-market reaction to what they say, and then we'll be able to see, in context of what the stock has been doing more recently. We'll also be able to see the changes and the market maker move. This has even changed a little bit more since we started our class, up another 1.5%. Okay, so hopefully you'll find that useful as well. All right, for those of you that need the grid, tell you what we're going to do. I'm actually going to delete this. We're going to look at another example here. We're going to look at Mara Holdings, and we're going to take a kind of a look back here. And so let me post this little script for that grid. Let me post it in a text box right here. So those of you on the recording, you can hit pause, you can write that down. Go ahead and add it if you would like to import that script. All right, we'll take a quick look. Make sure we answered the questions along the way. You guys are keeping Cameron really busy here. The reason somebody would do this trade is they're expecting a big move and they think there's room to capitalize on it. They're thinking, because this big move that's coming on, maybe we salvage some of the losing leg and then we get a good move out of the winning leg. And many times that can point to a positive picture, but not always. The fear somebody's had here was, well, what if it moves really, maybe it moves really small and then the implied volatility comes crushing out of it, we don't get the big move. That certainly is a risk of these strategies. Okay, certainly is a risk. Now let's look at Mara. Here is their most recent earnings, and they're due to announce tonight as well. Okay, so they announce after the market is closed today. And so here on this one, they closed, let's get my drawing tool, my temporary one here. They closed here. They did what? They gapped up about almost 5%. They ran higher. They got up 8% at one point. But by the end of the day, they dropped almost down pretty close to where they started. Went down a little lower, but yeah, so a little bit of a drop. But then over the next few days, 2 days, it continued to drop. By the time it finished dropping here, that was almost a 9.5% move. Okay, so let's go to the next earnings. Same thing here. This is where it closed. It opened up here, ran for a bit, and then pulled back. So somewhat of a move, kind of a medium-sized move. And then let's look at the most recent one. The most recent one, it closed here the night before, gapped up here. That looks like about 14.5%-ish, something around there, ran a little bit higher, but then quickly just faded. Didn't keep the whole move, but here at the end of the day, it was still up about 6%. Okay, and so we might have made a decision somewhere in this day. We could have held on to say, well, let's see, we've seen it fade. Maybe it's going to fade tomorrow, and look and see if it faded the next day, because it actually opened up down here, right? And then it continued to run. So these tend to be a little bit on the volatile side. Again, that's why I say it's not a bread and butter strategy most of you are going to use. It's probably going to be a strategy that you use at times when there's a big news event that you think you can capitalize on. All right. So again, they are going to announce tonight after the market closes. So we'll be watching it using that grid that I gave you. All right, let's go see what we can put together on Mara. Now notice this is a little bit lower price stock. The market maker move here is $1.11 and it's about 8.22%, which I'm going to say is high, not nearly as high as what we were seeing on HIMSS. Now, as we come over here to the option chain, look at this. This stock has already traded 19 million shares so far today. Now, these guys are a Bitcoin mining and artificial intelligence type company, which, you know, has had some streaks lately, some streaks up, some streaks down. But there's a lot of trading activity here. If we look at our options that expire on Friday, we can see 132% implied volatility priced into it. The next week out, 109. And then you can see it kind of drops into the 90s after that. So pretty hefty amount, not as much as HIMSS, but still a significant amount here. Now on this one, let's just kind of go out a little bit in time here, okay? Let's first look at the May 22s. Do we have a lot of open interest here? Well, here's my open interest column on the calls, thousands and hundreds in most of those strike prices. Not as many in the puts, but those that are out of the money and near the money, not too bad. Those that are in the money on the put side, there's very few trading there, but generally we're not going to be going in the money on these. We're going to be going at the money or out of the money. Now, right now, stock's at 1347, so our 1350 is going to be our at the money option. Now, if we were looking at a straddle here, we might come over here and say, oh, there's 693 contracts on the call side, but on the put side, is there? No, there's 3. So we're like, no way do we want to do a straddle in this situation. There's not enough open interest here. So we're going to do a strangle. We're going to go a little bit out of the money. If we even go 50 cents out of the money, we've got 172 contracts. If we go $1 out of the money to the 12.5, we've got 291 contracts. Now, we're going to kind of go with this 13. One, because it's not as far out of the money, just 50 cents out of the money. And because there's a little bit more open interest here, we really would not want to deal in any of these. There's just not enough liquidity there. And that's another key to this strategy, is making sure that you have some liquidity. And in this case, that's actually the determining factor why we're going to do a strangle instead of a straddle. Now, could we go out further in time? We could. But remember, the further out in time we go, the bigger move we need the stock to make, because the more expensive the options are. Okay, so let's see. So we're looking at doing here 1250, which is about 73 cents. I said 1250 and put my mouse on the wrong one. There we go, 1250. Is that when we're doing the 13, which is 73 cents? If we come down here to 13, it's going to be 88 cents. You might go, well, 73 cents and 88 cents, maybe that's not that big of a deal, right? Maybe we go out a little further in time and give the trade more time to develop, and you certainly could do that as well. We're going to stick with the ones that are just 11 days because I think we're going to be making a choice pretty quickly. So let's go with our 13 strike price here with the 172 contracts, 73 cents. And on the call side of things, it's going to be it's actually quite a bit more expensive here. On the 13, we're going out, however, to 14, right? Because we're doing out of the money. So about 79 cents. So they're grouped pretty close together there. So we need the stock to move about $1.46. The move that is expected through the Friday that they expire is looking to go about $2.08. So most of it is the market maker move of $1.12, $1.13. And then we have $1.12, $1.13, and then we have a little bit more time if maybe we need to allow one of the contracts to stay in play longer and make the trade a little bit more profitable, or even move it from a losing trade into a winning trade. Okay, so that's what we're going to do on tomorrow. We're only going to do the strangle here. So same thing, we're going to hit confirm and send. We're going to send it to our straddles and strangles. And then in our grid tomorrow, or actually later on, we'll put in here, we'll put an MARA. We'll be able to track both of them together and see what they're doing. Okay, that's why this grid can be fairly helpful, specifically with looking at earnings trades. All right, let's look at making sure we've got all the questions answered here. Let's see, Roger says, after the earnings are posted and we completed the straddle, can you confirm if we need to sell or close the call or the put? Fantastic question here, Roger. We want to make sure that we are closing out these trades. The plan is one, hopefully we'll move big in the direction of either our call or our put. If it's bearish, we're going to hang on to our put. We'll quickly sell the call. If it moves bullishly, more likely than not, unless we're getting like a lot of volatility and we're not even sure which way it's going to settle, then the plan will be, okay, whichever way it settles, we'll keep that leg. Say it goes to the bullish direction, we'll hold on to that call. We'll sell the put, see what we can salvage out of it to make our break even to maybe a little bit lower than what our net debit is getting into the trade right now. Okay, good question. We will always be closing out both of these trades. We will want to, I should say. Now, if you get in a coma and you can't close it out, your broker's going to do something on your behalf, but in an ideal world, would want to make sure we sell these. All right, we need to do a quick follow-up from a trade from last week. This trade really exhibits why sometimes these are really volatile stocks and a little bit tricky to work with. We did a straddle on Pinterest. And look at this, you guys. It closed here. And the next morning, it gapped up here, which was about 18%. It was huge, but it only stayed there for a microsecond. And then it began to drop. So this one was a little tricky to take profits on, and you'll notice it never went back up there since. Okay, the initial call here was that it looked like the call was going to be the winning leg, the put was going to be the losing leg. I'll show you in here. We still, because of that, we still have our call. We sold our put. It's not very profitable right now. Fortunately, it doesn't expire till this Friday. And so we have a little bit of time for it to gain some momentum. However, I'm going to tell you, I'm not super hopeful. Okay, if it closes down today and closes down tomorrow, we'll probably just clear out of it, possibly even today, and just take what we can salvage out of it. Because if it doesn't start moving quickly in a bullish direction, it's not likely to. And so we might as well just salvage what we can out of the remaining leg. Okay, again, these are speculative trades. Now, I hope you guys have become subscribers to our Trader Talks channel on YouTube. Makes it so much easier for you to find our content. In fact, if you do, you'll be able to basically see our scheduled lineup during the day. So we're doing our straddles and strangles here. Next up will be Barb Armstrong with Trading a Smaller Account. I know lots of you love Barb's class. She does such a super job there. Cameron, who's in our chat here, he's on deck today as well. Cameron, in a couple of hours, will be doing covered calls and short puts. He'll be teaching on which to choose, covered call or short puts. He's going to go through a discussion there. So really helps you find our content. You can go into our playlist. You can go back and look at old archives of classes. Just makes it really handy. So I'm going to encourage you to be a subscriber if you haven't already. Click that subscribe button. It's in the bottom right-hand corner. It's kind of blue. It looks like YouTube. And that'll allow you to subscribe. But just do it once. Okay, if you do it again, it'll unsubscribe you. It'll be like a toggle button. So just do it the one time and then you're good. All right. You guys have been great today. You had a lot of great questions. Appreciate Cameron helping out in the chat. He filled a lot of those questions. And I'm going to encourage you, if this is a strategy that's intriguing to you, you just want to get a feel for it, go ahead and do the practice trades in your own paper money account. Then you can see what questions you have along the way. You can write those questions down. And when we go back and review both those, all of those trades from today, then hopefully you can get your questions answered when we discuss the play out of the trade and what happened with it. So I encourage you to do that. Is the best way to learn strategies is to paper trade them. Follow Cameron and I on X. Would love to see you follow us. I'm Connie Hilsias. He is Cameron Macias. And if this was helpful to you today, go ahead and hit the like button on the way out. I did not see a survey in here today, so you're off the hook for any surveys, but would appreciate a follow. So thank you so much for being here. Stay tuned at the top of the hour for Barb Armstrong and trading a smaller account.